Welcome to your daily global economic briefing. Let's dive straight into the top stories shaping your world in the last 24 hours. First up, a major development from the United States Federal Reserve. New inflation data just released shows a slight but unexpected cooling. The Consumer Price Index, a key measure of what you pay for goods and services, rose less than economists predicted last month. The Fed, which has been aggressively hiking interest rates to tame soaring prices, is now facing a new dilemma. What does this mean for your wallet? It could signal that the pressure on mortgage rates and loan costs might ease sooner than expected. For businesses, this might mean a slightly cheaper cost of borrowing, potentially encouraging investment and hiring. The big question now is whether this is a temporary blip or the start of a genuine downward trend in inflation. The world's financial markets are holding their breath for the Fed's next move. Over in Europe, Germany's industrial heartland is flashing a warning sign. Factory output, a cornerstone of the German economy, has fallen for the third consecutive month. The data, published by the Federal Statistical Office, points to weakened global demand and persistently high energy costs. Why does this matter? Germany is often called the engine of Europe, and when its engine sputters, the entire continent feels the tremor. This slowdown could ripple across the Eurozone, impacting everything from car manufacturing supply chains in Poland to luxury goods sales in France. For the average German worker, this could mean worries about job security in key industrial sectors. For European policymakers, the pressure is on to stimulate growth without reigniting inflation. Shifting our focus to Asia, China's central bank has made a surprising move. It injected a significant amount of liquidity into its banking system overnight. This is essentially a cash boost to encourage banks to lend more money to businesses and consumers. The move comes amid growing concerns about China's property market and sluggish consumer spending. This isn't just a domestic issue. As the world's second-largest economy and a manufacturing powerhouse, a slowdown in China sends shockwaves globally. For international companies like Apple or Volkswagen, which rely on Chinese consumers, this could mean lower sales. For countries that export raw materials like iron ore or copper to China, it means weaker demand. Could this signal a more aggressive stimulus package is on the way from Beijing? That's the billion-dollar question traders are asking from Shanghai to New York. Now, let's talk about a commodity that affects us all: oil. Crude oil prices have jumped over 3% following a new report from the Organization of the Petroleum Exporting Countries, or OPEC. The group has revised its global demand forecast upwards for the remainder of the year, citing stronger than expected economic resilience in key markets. This decision comes just weeks after the group announced production cuts, creating a tighter supply. The immediate impact is being felt at the pump. You're likely to see gasoline and diesel prices climb in the coming days. For businesses, especially in logistics and transportation, this means higher operating costs, which could eventually be passed on to consumers in the form of higher prices for everyday goods. Meanwhile, in the tech world, a landmark ruling has just come down from the European Union's top court. Regulators have hit a major US tech giant with a record-breaking fine for anti-competitive practices in the digital advertising market. The ruling states that the company unfairly favored its own services, stifling competition from smaller rivals. Why is this a pivotal moment? It strengthens the EU's position as the world's leading digital watchdog and could set a precedent for similar cases in the United States and elsewhere. For consumers, this could eventually lead to more choice and innovation in the apps and online services we use daily. For smaller tech startups, it could level the playing field, giving them a fairer chance to compete against the industry's titans. Let's turn to South America, where Brazil's agricultural sector is celebrating a bumper harvest. The country's national supply company, CONAB, reported record-breaking soybean and corn yields, boosted by favorable weather conditions. As one of the world's largest food exporters, this is significant news for global food security. An abundant supply from Brazil could help to lower global prices for essential food commodities, providing some relief for import-dependent nations, particularly in Africa and the Middle East. This could help to ease food inflation, which has been a major concern for households worldwide. For the Brazilian economy, it's a welcome economic boost, strengthening its trade balance and supporting its currency. Back in Europe, the United Kingdom's housing market is showing signs of stabilizing after a turbulent period. The latest figures from a major mortgage lender indicate that house price falls have slowed significantly. While prices are still down from their peak, the rate of decline has eased, suggesting the worst of the downturn might be over. This is largely attributed to mortgage rates beginning to edge down from their recent highs. What does this mean for homeowners and first-time buyers? For current owners, it reduces the risk of negative equity. For those looking to get on the property ladder, while affordability remains a huge challenge, this stabilization might provide a clearer picture of the market, making it easier to plan. It's a tentative sign of returning confidence in the UK economy. Now, for a story about the future of work. A major global investment bank has just announced a stricter return-to-office policy, requiring most of its employees to be in the office 5 days a week. This move goes against the hybrid work trend adopted by many of its competitors. The bank argues that in-person collaboration is essential for productivity, training, and company culture. This decision reignites the debate over the post-pandemic workplace. Will other major corporations follow suit, or will they stick with flexible arrangements to attract and retain talent? The outcome will have a massive impact on everything from city center economies, which rely on office workers, to the work-life balance of millions of employees. It's a tug-of-war between traditional corporate culture and the new expectations of the modern workforce. Let's head to Japan, where the yen has weakened further against the US dollar, raising concerns at the Bank of Japan. The currency slide makes imports, especially energy and food, more expensive for the Japanese public. This divergence is happening because while central banks in the US and Europe have been raising interest rates, Japan has kept its rates at ultra-low levels to try and stimulate its economy. The question now is whether Japanese authorities will intervene in the currency market to prop up the yen, a move they have made in the past. For international tourists planning a trip to Japan, a weaker yen means their money goes further. But for Japanese households, it means a higher cost of living. In environmental, social, and governance news, often called ESG, a coalition of major institutional investors, managing trillions of dollars in assets, has issued a stark warning to the world's top fossil fuel companies. They are demanding more credible plans for transitioning to cleaner energy. The investors are leveraging their financial power, threatening to vote against company directors and support climate-related shareholder resolutions if their demands are not met. This represents a significant escalation in pressure from Wall Street on the energy sector. It shows that climate risk is no longer just an ethical concern. It's a core financial risk. For these energy giants, the message is clear. Adapt or risk losing the support of the world's biggest money managers. Finally, let's look at the global shipping industry. New data from the Drewry World Container Index shows that the cost of shipping a 40-foot container on major trade routes has continued to fall, approaching pre-pandemic levels. This is a dramatic reversal from the sky-high rates seen over the past 2 years, which contributed significantly to global inflation. The drop is due to a combination of slowing consumer demand for goods and an increase in the number of new ships coming into service. This is good news for retailers and manufacturers as it lowers their transportation costs. Ultimately, this should translate into more stable and potentially lower prices for imported goods on store shelves, from electronics to furniture, providing a bit of relief for household budgets. That's all for this global economic update. We've covered the shifting tides of inflation, policy moves from central banks, and the real-world impacts on industries and individuals. Understanding these forces is key to navigating our complex world. Thank you for joining us. If you found this briefing valuable, please like, share, and subscribe for more daily insights. We'll see you next time.